Hi guys, welcome to the part 6 of the market profile educational series. In this section we're going to study about what I call the confidence of profile. Now what I mean by this is that, see, we have covered the basics of market profile till now, and we have also covered the kind of profile types, that is a trend day, normal variation day, non-trend day, these kind of things. Along with that, we have also covered the opening type, in which we've covered open drive, open test drive, open reject reverse, open auction, and we have looked into value area concepts. In the mean process, we have also looked at the concepts of other time frame traders and why they are important to the market. In order to determine which other time frame trader is in control, we have looked at the TPOs, the range extensions, tails. What this section will do is give you an overall idea about what the confidence of the profile is. Basically, again, this is about testing the conviction of the other time frame trader and trying and visualize what kind of market opening or what kind of market direction is likely, going ahead into the future. Now there are certain filters, if I may call, to determine what is going on, and we are going to look at those aspects today. So the first thing that we look at is the value area confidence. Now value area, as I stated a lot of times, is the heart of market profile, and it's again basically giving you a kind of range where the most amount of trading has happened. You may call the fair price zone. If you look at the confidence level exhibited by the value area, then there are two ways to do that. Number one, within the profile or within the day profile, or whatever you call it, where has the price closed with respect to the value area, that is the profile's value area. And the second way is, where has the price closed today with respect to the previous value area. So what we are essentially doing is comparing the price with the current value area and the previous value area. Alright, before moving forward, there's one thing I want to repeat again. In range bound markets, price gets attracted to value area, and in trending markets, value area catches up with the price because price runs away quickly. Alright, understanding this concept or having this concept in the background is very important. Okay, so let's look forward. Okay, so see, when the market is trending either up or down, the price will always close towards the value area high or above it. Okay, and I'll come to these concepts. Now when the market won't trend too much, or it is a range bound market, then what will happen is price will eventually either fall back to the value area or kind of trade around it. Okay, this was with relation to price and the current value area. Now when the market is trending, then the current price will most of the time close above the previous value area. That is, if we are talking about an uptrend, then the current closing will always means 7 out of 10 times it will be above the previous day's value area high. Now for downtrend, the current close will always be below the previous day value area low. Okay, depending on which profile you're looking. Now if you combine these aspects, that is comparing price with current value area, that is developing value area, and the current price with the previous value area, then you get a lot of insight into what may happen in the future. Now see, let us take this example. Here what is happening, the current price is closing within the value area, right? Now see, this is the current profile, and look where the close is happening, that is above the value area high. Now this profile gives a little less confidence because here the close is happening towards the value area low, but in comparison to this profile, look the trend of the value area. Now look at this profile, the close is again above the current value area. Look at this profile, the close is again above the current value area. So in a trending market, what you will find most of the times is that the current close of the profile is near or above the value area high. That is for uptrend. Okay, now once you see this structure, instantly you can see that the value area is giving you confidence that other time frame buyers are present in the market. Now this was the case when we are comparing the price with the current value area, developing value area. Now let us see when we are comparing the price with the previous value area. So in a trending market, what happens is the price closes above the previous value area. Again, look here, the close is low, but when you compare it with the previous value area, it is still high. Again, look at this close, it is higher than the previous value area. Again, look at this close, it is higher than the previous value area. So what happens here is the value area is chasing the price. Okay, again in a trending market. Now once you start getting a situation where continuously the price is closing either below or overlapping with the previous value area, then you can start doubting the trend. Otherwise, this is a direct way how to measure the confidence, the value area confidence of the market. Okay, this is not covered in many market profile books. I've gone through both Dalton's book and this aspect is not covered. I don't know about Peter's book. There's a book by Tom Alexander. I don't know how many of you have heard of him. That book is also decent, but even in that book this concept is not there. But again, it's just common sense. It's not something that is exceptional or something. It's just common sense, nothing else. Now let us look again at this. This is a second profile, second trend. See the close when with respect to the current value area is higher. Look at this close. It may not be higher, but it is closer to the value area high. Look at this close. It is again greater than the value area. Look at this close. It is again near to the value area high. Now this close is below. That's okay. Now look at the close with the previous value area. This close is happening above the value area high. This close is again happening above the value area high. Now this close is again happening above the value area. And this close is now started overlapping. So when this kind of structure starts to develop, you'll get a rounding type, then a range bound, then eventually either an up or down phase. Those are the stages of market. I think we'll cover them in the next tutorial. Okay, so I hope you're getting the concept that just the value area of a profile, it can give out so much of tremendous information to a trader about the confidence in the market, about the confidence of the other time frame trader, that just by having a glance, you can come to know whether the trend is here to stay or whether the market is overlapping, or what is going on. Okay, I hope this segment is clear. Okay, the next type of confidence that we're going to see is the opening type confidence. Now remember, when we did the opening types, we studied 4 types of opening types, that is open drive, open test drive, open reject reverse, and open auction. Okay, in case you've forgotten what these basically are, just go and refer back to the definitions and the explanations. I think it was in tutorial 3. Now which opening type, like when the profile opens, which opening type is going to play out also depends a lot on what the value area is previously telling you, and the closing confidence in opening. That is something we're going to explicitly see in this section. Now why this is important is because let's say the value area has been trending up, you suddenly get a gap up in the market again. Now you can you can have two kind of, and the momentum is strong, what kind of openings can happen? Either you can happen an open drive, if it's towards the fag end of the bull run, then you could have an open reject reverse. It will be very unlikely for an open auction to happen because the momentum is so strong. So just by taking a look at the previous value area, the confidence level exhibited by the value area, and some of the filters that we're going to look at in the current opening type confidence, we can know what kind of market, what kind of profile is shaping up. That can give us tremendous advantage as traders. Now, why such type of filters are necessary? Because at times, when the market gaps down or gaps up, the opening type can be a little bit confusing. Confusing till the point a trader does not get a full hang of the day types and etc. So by looking at the confidence of the opening of the market, we can try and eliminate what kind of openings can happen, opening type can develop, or what cannot develop. Okay, and then again by taking into account the value area confidence, you can get tremendous insight into what is likely to happen in the future. Again, that has to be confirmed by the price. You can have a lot of opinions forming by the kind of profile structure that is shaping up, but that has to be confirmed by the price in the end. Otherwise, that will fall apart at some stage. So by the opening type, what is necessary is, let's say the market opens and the prices run away in the first 30 minutes of trading. Now we would like to see where the price is closing. If the price has rallied and it has come back and it's closing towards the low, then you would know that the chance of open drive happening is almost relatively zero, because the price is rallied, then they've again retraced back. That is not a confidence trait of a trader who wants to take the market higher. So these are the kind of filters we'll look at. Alright, so let's visit the first type of opening, open drive. Now see, what was open drive? Open drive was the type of opening when the other time frame trader just enters the market and right from the open takes the market higher. Okay, so one thing that stands out in the open drive open is that the confidence of the other time frame trader is exceptional. Okay, so usually in the first two intervals, that is if you're using 30 minutes intervals, in 1 hour you'll come to know what the indication of trend is, and if you align yourself with that, you can reap good profits. Now what usually happens is, let's say the market opens and the prices rally. When the A interval ends, it will end towards the extreme. For an uptrend, it will end towards the upper range of the interval, whereas if it's a downtrend, it will end towards the lower end. Okay, so just look at it first. So see, this is the open drive. Look what happens. The market opens here, it goes down, then where does the B interval open? It opens here. So the market more or less closed somewhere here in this interval. So this indicates a strong opening, and then the slide continues. Now if you look here, the market opened here, it rallied, and the B interval started here. So see, almost in this entire range, the market is closing in the A interval in the extreme, and then the B profile starts to build. So this indicates the confidence. This indicates the confidence of the other time frame seller in this case, and other time frame buyer in this case. In this case, if you see, the profile is much wide. It indicates more confidence, although when the initial balance is wide, you cannot expect a trend day with ease, but that is a different matter altogether. We are just referring to confidence out here. Okay, so I just hope this part is clear. So let's say a market gaps up or gaps down and then keeps going down, then the B interval starts near the low of the A interval, then you would know that this is a strong open drive in place. Alright, okay, in open test drive, what usually happens is that in the first two interval, let's say 30 minutes, 60 minutes, the market tends to test some reference level that we spoke about previously, let's say a value area high or a value area low, or low of the day or the high of the previous day, and then it you know um, rallies back in the opposite direction. So this kind of confidence comes as second best confidence. Why second best? Because usually in this case the low of the first interval, that is A period, is broken, and then the test happens and then the market rallies. So relatively there is less confidence when compared to open drive openings. So let us look at an example. See what happens. The market opens here. Initially the open test drive will look like open drive. So see, the market is opening here, it rallies, it closes here for the interval, that is pretty good. But then look what happens. The B interval goes down, then the C interval goes down. Here it has tested some previous value area low or a previous day high, and then it goes up. So as soon as, let's say, this entire profile is not there, we have only 0 to A now, O to A. Now here when the B interval opens, we can suspect that it's going to be open drive, but as soon as we see the B interval breaking the lows of the day, then we would know that it can be open test drive and it cannot be open drive. Alright, so this is how we are filtering out. Now see, look what happens here. The market opens, A interval completes, it opens again here, which is towards the upper 25% range, which is a strong opening. Here again we can suspect the open drive might happen, but in the BCD interval we come to know that either at this stage we could have an open auction where the price would just zigzag, or we could have a open test drive. Alright, so this is how we try and eliminate. Okay, so let us look at the third aspect. The third is the open rejection reverse. Now if you know, this kind of profile I had said usually happens in the bear markets, and usually when the volatility is high, and in the first 1-2 intervals, it does appear that one time frame trader is in control, it does appear that open drive is in place, but suddenly you will see the reversal happens and the confidence is dented and the market just reverses. So this kind of opening goes in the opposite direction. So let us look at the example here. Yeah, so see what happens. From 0 to A we see one time frame activity, then again the B interval opens here, so we do suspect that this is going to be open drive. But then look what happens. C interval opens and it climbs back above the B interval's high. Now this is usually the first sign that open drive cannot happen. And once the rotations begin, now this is a hand-picked example, so easily I can tell you that these rotations are happening way into the A interval range, and hence we can see this rally. But in real time, what you need to know is that one time frame market, usually open time markets, do not easily let the developing intervals breach the previous intervals low or high, depending on how the profile is. Alright, don't get too caught in definitions, but most of the time it happens like that. Okay, 1 or 2 breaches is fine, but consistent breaches won't happen. Now look what happened here. The market opened, it auctioned higher, but again it came down, it closed at the lower end range, then the B interval formed. At this stage we can suspect that open drive is in place, but look what happened. The C and D interval went way into the A interval prices, as well as above the B interval high and the C interval high, that is the D. So you could easily make out that open rejection reverse is in place, because see, had open drive been there, the previous lows, if you see, they are not easily broken. 1 or 2 times they will be broken, but majority of times when the trend is formed, it does not break. So this gives you a good idea that the open rejection reverse is in place. Now see, when you're eliminating the opening types, it usually isn't a difficult task to do, because there are only just 4 types, and usually on a given day you can just eliminate 1 or 2 within the first 2 hours. So then, combined with the kind of profile profile is forming based on initial balance, it becomes relatively easy to spot that. Let us take a look at the last opening type. Yeah, the last type was open auction. This is a no-brainer. Open auctions are dull and listless market. You'll mostly find the rotations within the initial balance or the opening range. What you see is that when, let's say, the market opens, the initial A interval forms. You won't see the prices closing well above into the A interval. It will close somewhere in the middle. Then the B interval will start opening. You'll get a sluggish close. Now these are the kind of profiles which form when the market is getting tired, especially during after a bull run or after a bear run. So these are rotation kind of profiles where the price just rotates at one point. Consolidation kind of profiles. Let me see if I have an example of this. Open auction, yeah. So see what happens. The market opens here, then it rallies down, then it again rallies up, then the B interval opens here, it rallies somewhere around here. Look at the CDE rotations. Now as the day develops, open auction is much clearer. But if you take a look here, let's say the market opens, it auctions down, then it auctions up, the B interval starts here, you would immediately know that open drive cannot happen. Okay, why? Because open drive you don't find two-way auctions so much. Okay, then what you can suspect is open test drive. In open test drive, let's say this is a negative profile, okay, for downtrending. What happens is B auction rotation happens, but see, B is not going out of the A range, which means it is not trying to test either a previous day low or a previous value area low. It is just rotating within the A period. So this also gives you a clue that not much market activity is happening out there. So these are the open auction. Open auction usually in bull markets can happen when the market gaps up and price just needs to find a new value, so it will keep rotating there. It's one of the most irritating type of opening type market which happens a lot, and I must say it is very difficult to determine in the real term, although if you apply these filters it will get easier. Why it is difficult is sometimes the market tries to print a or B or a C letter outside the range, and it gives a false impression to the trader that a breakout is happening, or let's say open test drive is forming, but then it again falls back into the range and it starts rotating in a very narrow range. So it gets very frustrating for a trader. Okay, so again if you see here, what happens is we open here and the price goes up, then it again rotates down, then B opens here, again B shows no activity, C shows no activity. If you're getting 2-3 profiles within a particular opening range or the initial balance, and plus you have seen the market has moved reasonably in the past, you could be pretty sure once you rule out, let's say, open drive, or you rule out open rejection reverse, then you get a choice between open test drive and open auction. Then you look at where the value area is. If you're seeing the value area is overlapping, then you would know that the chances of open auction forming are low. Whereas if you see the value area is trending, then you may get an open test drive. So see, nothing is on standalone basis. It's like a puzzle that you have to form. What usually happens is, as soon as the market opens, we try to label what sort of opening is this or what sort of day can form. That is, I think, a wrong approach. What you need to do is, before the market opens, you need to do your homework. You need to see what is the value area trend, what is the value area confidence, what are the kind of profiles that have formed during the past few days, what is that suggesting. Try and ask yourself which other time frame trader is in confidence. These are the kind of aspects you have to put together. Now this I will cover in a framework that I'll give you much later in the tutorials, but don't apply any concept on standalone basis and see this may happen or that may happen. No, you have to combine everything together and form a sort of a profile for yourself, and then you would know within that profile what the market is doing and what it's not doing. Alright, yeah, so in the next section I think we're going to cover about volume and market stage analysis. That is to know how basically a bull or bear stage functions, how the profiles behave in that, and what is the importance of high volume area nodes and low volume area nodes, and how can we use them in trading. Alright, so I just hope this aspect is clear. It was an important topic. It will help you now know what kind of opening is coming up for a particular profile, and that will give you insight into what kind of market might shape up into the future. Alright, so see you guys until next time.